In this video, we are going to talk about dividend stocks to buy and hold forever. So before starting this video, please like this video and subscribe to our channel for the future updates. To escape the higher tax burdens associated with day trading, investors must hold a stock for at least 12 months, according to the concept of long-term capital gains. Many on Wall Street, however, assume that true long-term investment is measured in years rather than months. This is evident in the incredible success of high-growth stocks such as Tesla, ticker TSLA, which has risen more than 1,300% in the last 5 years despite a lot of short-term volatility. In mature dividend stocks as well as disruptors like Tesla, however, buy and hold investing can be a lucrative strategy. Because of their stable businesses and generous dividends, these sleepy megacap stocks also have reliable long-term returns. If you're a long-term stock market investor, consider one of these 7 dividend stocks, which are so well established and stable that you can keep them for as long as you want, possibly indefinitely. We found a dozen stocks that have paid annual cash dividends for at least a century. That isn't to suggest that they've given raises every year for the past 100 years. Some, on the other hand, have never reduced their dividend. The majority of these businesses have modest beginnings in a garage, but they are far from quaint. Most have grown into massive, multifaceted, global companies that provide both growth and dividends over the course of their long histories. Take a look at this interesting income stock list. You may be surprised by some of the titles. Here's a list of the dividend stocks to buy and hold forever. Let's start number 10, Procter Gamble Co., PG. P&G is in a class by itself when it comes to consumer staples stocks, with a diverse and strong range of products that includes Gillette razors, Pampers diapers, Tide detergent, Tampax feminine products, herbal essences, and Pantene hair products, to name a few. To say the least, almost everyone who goes to the supermarket returns with something from PG in their shopping bags. Although there isn't a lot of breakneck growth or creativity in personal care goods, there is a lot of dependability. That adds up to a steady stream of cash in good times and poor, allowing you to count on a generous dividend for the foreseeable future. This steady dividend stock isn't going anywhere, with $70 billion in annual sales and nearly $17 billion in operating income. Number 9, Consolidated Edison. For 130 years, utilities have been a great source of dividends, due in large part to New York City's power utility. COND is now on track to break a record of 42 consecutive annual raises. Wall Street analysts frequently scoff at utilities, despite the fact that they have proven to be excellent investments. So take certain negative viewpoints with a grain of salt. The safe harbor provisions of Section 27A of the Securities Act of 1933, as amended, and Section 21E of the Securities Exchange Act of 1934, as amended, apply to forward-looking statements in this press release. Forward-looking statements are predictions rather than evidence about the future. Forward-looking statements are identified by words like forecasts, expects, estimates, anticipates, intends, believes, plans, will, target, and similar phrases. The forward-looking statements are based on knowledge and assumptions available at the time they are written, and therefore speak only as of that time. Number 8, Eli Lilly. Lilly, a research-based pharmaceutical firm that has never dabbled in anything else, ended 2015 with a 25% gain. Despite a 9.8% loss so far in 2016, it has an annualized average return of 17.1% since 2010. Lilly's current diabetes, cancer, and pain medications, as well as Prozac, were not on the company's initial menu, but it made a name for itself by developing the first commercially available generic insulin. Number 7, Johnson Controls. Johnson Controls is a volatile stock with a history of 40% year-over-year growth accompanied by long periods of weakness. As it completes the spin-off of its automotive parts companies, Johnson will be left with energy efficiency and protection systems for commercial buildings, which could help it become more stable this year. Number 6, Johnson & Johnson, J&J. Forget about J&J's recent surge in popularity as a result of its development of a single dose of the COVID-19 vaccine. A diverse portfolio of healthcare supplies, prescription medications, and consumer health goods including Band-Aids and Tylenol gives this stock real long-term promise. In reality, J&J stock has such consistent sales that it is one of only 2 U.S. companies with a perfect AAA credit rating, the other being Microsoft Corp. MSFT. When you consider that this mega corporation just announced its 58th consecutive dividend raise with its hike last year, it's clear that this is a portfolio that is dedicated to rewarding shareholders generously over time. Number 5. JP Morgan Chase & Co. JPM. Several banks, including Citigroup, C, and Bank of America, BAC, took a beating during the financial crisis of 2008. But JP Morgan Chase, JPM, emerged as Wall Street's most resilient financial stock. For example, after cutting its dividend during the worst of the chaos, it was back to pre-crisis payouts of 38 cents by 2013 and now pays a generous 90 cents per share. Simultaneously, since the beginning of 2007, JPM stock has outperformed the S&P 500 as a whole, while BOFA and Citi are substantially undervalued when compared to 2007 levels. JPM has what it takes to be a long-term investment, as shown by this. Number 4. Intel Corp. INTC. Over the last year or so, there has been a lot of discussion about whether Intel has what it takes to stay competitive now that it has floated the possibility of exiting the chip-making sector. The harsh truth is that the real money is made in the design and patenting of luxury microchips, not in the mass production of them. This is why Intel, with its extensive intellectual property, is priced several times higher than smaller foundries that operate on razor-thin margins when manufacturing chips built by others. It's also why Intel's dividend has risen from 18 cents in 2011 to nearly 35 cents now, owing to the high demand for semiconductor patents, which generate consistent revenue like clockwork. It shouldn't matter whether Intel prints the chips itself or not unless you believe Intel's best-in-class designs are going away or that products will use less chips in the future. Intel is a stock to buy and keep forever, given the ever-increasing demands on these goods in the digital era. Number 3. Home Depot, HD. With $140 billion in annual sales and almost 2,300 locations, Home Depot is the largest home improvement chain in the United States. Although HD is a cyclical stock that may experience some short-term ups and downs due to housing market or spending patterns, it has proved to be a fantastic long-term profit generator thanks to dividends and share price appreciation. Consider that HD stock has increased by 760% since 2011, compared to around 200% for the S&P 500 over the same time span. Simultaneously, dividends increased from 25 cents per quarter in 2011 to $1.65 per quarter today. Whatever you think about short-term fluctuations, with those kinds of returns, this is a stock you'll want to purchase and hold forever. Number 2. Coca-Cola Co. Warren Buffett and his Berkshire Hathaway, BRK, investment company made a $1 billion investment in Coke stock in the late 1980s. Berkshire's interest in Co has risen to around 9% of the company's outstanding stock since then. The fact that Berkshire Hathaway and Warren Buffett have been riding high on Co stock for so long proves that it is a stock to buy and keep indefinitely. But, just in case you needed more proof, Coca-Cola recently announced its 59th consecutive annual dividend raise in February. Moreover, those annual raises haven't been small. Co now costs 41 cents per quarter, up from 17 cents at the start of 2007, just before the financial crisis, and nearly double the 22 cents paid a decade ago at the start of 2011. Given that Co raised its dividends through the current pandemic, the Great Recession, and all in between, this legendary consumer company has earned a clear vote of confidence. Number 1. AT&T. Let's face it, AT&T is the country's leading wireless service, with more than 40% of all wireless subscriptions, and it's not going anywhere. Sure, its competitor Verizon, VZ, isn't far behind. And if the number 1 and number 2 providers switch places in the future, neither would disappear too soon. The demand for data is constant in the digital era, which makes AT&T's revenue stream extremely stable. Its dividend isn't going anywhere, either, as the $2.08 payouts are comfortably below the $3.15 in expected earnings per share this year, accounting for just 66% of overall income. Long-term investors will depend on AT&T for several years to come in an industry where consumers are very sticky, and the barriers to new entrants are extremely high. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.